As you know, we have a little event coming up called the G20. Lots of anticipation around that. Not huge moves, a bit of a rally for stocks and bonds into that. What are you seeing in the options market? Are there any ways to see what the outcome could be through options?
Yeah, so one of the things that I wanted to talk about today was thinking about options as far as implied distributions, or really taking the concept and saying where do I make money or where do I not make money. So I think one of the things we prepared was a little run through on Russell 2000, NASDAQ, and S&P on how big of a move do you need to get to have a market neutral option strategy actually make money.
Well, that's an interesting point that you're making, because you're looking for a market neutral strategy, so
Yep.
Directionally agnostic. So you really don't care whether the bears or the bulls win out of this, but you are looking for some volatility to take advantage of. And you were talking about a straddle to do this, correct?
Yeah, correct. So in this example, in this trade example, we're using buying a call and buying a put.
Can you talk to us about a straddle first, exactly what that is?
Yeah, sure. So if you buy an at-the-money call and buy an at-the-money put and package them together and then look at the aggregate dollars spent to buy that package, that ends up being your break-even for whether you make money or you don't make money on that particular position. So the straddle is buying the same expiration, the same strike on the same underlying security.
And not only do we have the G20 ahead, but we also have earnings season. So let's now talk about what you were referencing in terms of the IWM, the SPY, and the QQQs. I think on the July 19th expiry.
Correct, yep. And so what we have there listed is sort of a run through of what type of a move in percentage terms would you need to experience if you bought the straddle on each of those three today. And then we also have listed there, what have we experienced over the last 20 days, just to put it into context there. So I think you can see that you don't need to get an abnormally large move in any of those three indices to actually make it pay off to be long volatility with no market direction.
And it looks like those QQQs would be the most attractive, just considering that over the last 20 days, I'm seeing that they moved by 5.5%. So in order to make money, they need to expire moving greater than or less than, or greater than up or down 3.8% by July 19th. Is that correct?
Yep, that's correct. And with the amount of information and events coming up that we have, I think the chances of that happening are pretty good. There's obviously a lot of hope and optimism in the G20 conversations, but there's certainly some downside built in there. One tweet can move the market, as we all know very well. So not only do we have the G20, but we also have the beginning of earnings season and a lot of things that are going to move valuations. So I think it's a relatively good